You wake up one morning, check your phone, and suddenly the price of your favorite stock has exploded or collapsed overnight. You didn't make a move. Most people didn't. So what on earth caused it? Who pulled the strings? Was it a hidden group of billionaires? Some ultra-smart algorithm? Pure chaos? Today, you're going to discover the surprising truth about how stock prices are actually set. And by the end of this video, you'll understand the exact mechanism that moves the market every single second, even if you're a total beginner. Before we jump in, let me ask you something. Have you ever bought something online and noticed the price going up the next day? You probably wondered, why did the price change? What caused it? Well, the stock market is like that, but times a million, and happening non-stop. Now let's break this down in the simplest way possible. Think of a stock like something being sold at a giant global marketplace. Just like a farmer's market, except instead of apples and tomatoes, people are buying and selling tiny pieces of a company. At this market, the price of a stock doesn't come from the company itself. Apple doesn't wake up and say, "Our stock should be $172 today." Tesla doesn't decide its stock price. Amazon doesn't set it. Instead, the price comes from one thing: people buying and selling. But what exactly determines that price at any moment? Here's where things get interesting. Imagine you're selling your phone. You want $200 for it, but someone else offers $150. Another person offers $180. Someone else is willing to pay $190. What's the real price? Well, it's the highest price someone is currently willing to pay, matched with the lowest price someone is willing to sell for. This is exactly how stock prices are set. Buyers place bids. Sellers place asks. When a buyer's bid matches a seller's ask, boom, the stock price changes. It's like a constant tug-of-war between buyers and sellers. If more people want to buy a stock than sell it, buyers start competing and offering higher prices. And if more people want to sell, sellers start lowering prices to attract buyers. The balance between those two sides, supply and demand, is what sets the price every single second. But here's the twist most beginners don't know. The stock price you see on your app is not some official value. It's simply the price of the most recent trade. The moment another trade happens, the price can change again. This is why sometimes you open your trading app and see the price bouncing up and down like a heartbeat monitor. It's not random. It's millions of tiny negotiations happening instantly. Now let me ask you a question. Do you think people buy stocks more because they believe in the company's future, or because they're afraid of missing out when others are buying? What do you think actually drives more of the buying behavior? Drop your answer in the comments. I'd love to read your thoughts. Let's go deeper. The biggest reason stock prices move is because of market sentiment. Basically, how people feel. If investors feel confident, they buy. If they're scared, they sell. It's emotional. Humans move markets more than math does. But sometimes, prices move because big institutional investors, pension funds, hedge funds, or giant banks make massive trades. Their buying or selling can shift prices dramatically, even if small investors want the price to go the other way. Imagine being in a pool. If you swim from one end to the other, the water moves a little. But if a whale jumps in, huge waves. Big investors are the whales. Now let's add another layer. Information. When news comes out, like an earnings report, a CEO scandal, a new product launch, interest rate changes, or even a tweet, people react. Some buy immediately, some panic sell, some wait. But the moment buyers and sellers change their behavior, the price adjusts. And here's something you'll find fascinating. Sometimes the news itself doesn't even matter. What matters is how the market expected people to react. If everyone thought a company would have terrible earnings but the results were just kinda bad, the stock might actually go up because it wasn't as bad as expected. It's not about good or bad news. It's about expectations versus reality. Have you ever noticed a stock going up even after bad news? Why do you think that happens? Share your answer in the comments. I'm curious to see your take. Now let's talk about something most beginners have never heard of. Order types. They play a huge role in how prices move. A market order is when you say, buy this stock right now at the best available price. These orders prioritize speed, not price. If you place a market buy order and the lowest seller wants $100, you pay $100. If the lowest seller suddenly changes their ask to $101 before your order hits, you pay $101. This is one of the reasons prices can jump instantly. A limit order, on the other hand, says, buy this stock only if the price reaches this amount. Limit orders add stability to the market because they create a list of what buyers and sellers are willing to accept. Market orders chew through that list, moving the price. Think of it like a giant stack of sticky notes. On one side, buyers write the highest price they're willing to pay. On the other side, sellers write the lowest price they're willing to accept. The top sticky notes meet, and that becomes the price. Now here's a question for you. When you buy stocks, do you prefer using a market order for speed or a limit order for control? Tell me in the comments. I'm curious which one you trust more. As we continue, let's dive into something else that shapes prices. Trading volume. If a stock has high volume, meaning lots of people are actively buying and selling, the price tends to move smoothly. But if a stock has low volume, even a small order can cause big swings. This is why some cheaper or lesser-known stocks jump dramatically from tiny amounts of buying or selling. They have thin liquidity. It's like trying to move a small boat versus a giant ship. A tiny push can move a small boat across the water, but a giant ship barely moves unless you use massive force. Now, here's something really fun to think about. If stock prices are just the result of people negotiating in real time, can anyone truly predict prices perfectly? Some people say yes, others say it's impossible. What do you think? Are stock prices predictable or not? Drop your answer below. I'd love to hear what you believe. Let's go even deeper. Algorithms, computer programs, now handle a huge percentage of stock market trades. These programs buy and sell in fractions of a second based on rules created by humans. They react faster than any person can. But these algorithms also follow the same basic principle. Buy at one price, sell at another, match bids and asks. So whether it's humans or computers, the rule is always the same. Buyers and sellers set the price. Now imagine a moment when thousands of traders suddenly panic, maybe after bad economic news. They all start selling. But who's buying? When there are fewer buyers, sellers have to lower their prices to attract them. That's when stocks drop fast, and the opposite happens when excitement takes over. Imagine a company announces a revolutionary technology. Suddenly, everyone wants to buy, but there aren't enough sellers. Buyers start offering higher and higher prices, and the stock skyrockets. This is why the market feels emotional, even when the underlying system is logical. By the way, if you're enjoying this breakdown so far and you're learning something new, make sure you like this video, subscribe to the channel, and share it with someone who wants to understand the stock market. It really helps the channel grow, and I appreciate it more than you know. Now let's explore one more thing, the concept of fair value. Some people think stocks have a true price, a price based on the company's actual performance, earnings, debts, growth, and so on. Analysts study companies to decide what they believe the fair value should be. But here's the twist. The market price can be very different from the fair value. Sometimes the stock trades way above it because of hype. Sometimes way below it because of fear. So the market price isn't always rational. It's just the price buyers and sellers have agreed on in that moment. Think of it this way. If you think a house is worth $300,000, but someone offers you $400,000 for it, the market price just became $400,000, even if you think that's too high. The same is true with stocks. Here's a question for you. Do you personally think stocks should be priced based on logic or emotion? Which force do you think actually wins in the real world? Leave your answer in the comments. I'd love to hear your view. Finally, remember this. The stock market is not magic. It's not random. And it's not controlled by some secret group. It's simply a giant auction happening every second, driven by millions of people making decisions based on information, emotion, and expectations. Once you understand that, the market becomes a lot less intimidating. If you found value in this video, hit the like button, subscribe, and share this with someone who's trying to understand how the stock market works. And before you go, answer this final question in the comments. What do you think influences stock prices more, fear or greed? I can't wait to read your answers. Thanks for watching, and I'll see you in the next one.